The daily chart here on the left-hand side, you can see we had a buy side unbalance, sell side inefficiency. It's shaded in blue. Notice that it had no interest at all getting down to the upper quadrant. It used the top end of the, which is this candlestick's low. It hit once here, twice, and then said, "I got to go." And that is what you want to see. When you're in a bullish market, when you're looking for bullishness, you do not want to see my fair value gaps traded down into. You don't want to see them go to their quadrants. You certainly don't want to see them go to consequent encroachment. You don't want to see them completely close in. You have to have inefficiencies left open to indicate what? Strength. And if you're bullish, you want to see inefficiencies not be offered as a fulfillment lower. Because if the premium is real and it's an instrument that is technically undervalued, why would they offer the discount price? They wouldn't. If you had the hottest thing right now that everybody wanted to buy at Christmas time, would you offer sale prices on it? No. You're going to keep increasing the price higher, higher, higher. Well, that's what the algorithm does. It just keeps offering higher price. And everybody's doing market orders all the time. Now, when we're looking at inefficiencies like this, we want to see price literally stay open. Because if the inefficiencies can stay open or fail to even touch the quadrant levels and it starts to rally, man, if you're long, that's when you want to start adding to your longs. You want to build in larger positions. That means every time you have a short term retracement, anything intraday, you want to build that position up, build it up, build it up, build it up, because it's already indicating strength. And when prices is going lower, if it's leaving inefficiencies open and doesn't come back up into them, if it can't even touch the lower quadrant when you're bearish, that's really bearish. Well, in the same sense here, just reversing it, when it's bullish like this, we don't even want to see it trade down in the upper quadrant, and it doesn't do that. And go back and look at the tweet. I just said it a little while ago. So we're going to see 4,000, and I don't see it stopping there. I see 5,000 gold easy. Like I see it. It's no reason for it not to be there. You need to have rule-based ideas and things that lean on that you can trust. And one of the things that I found the most trust in is when my fair value gaps form in price action. If they can't draw price down into them and I'm bullish, I'm wildly bullish then. Like I'm really bullish. And every indication post fair value gap not being traded into like it does here, everything past that on an intraday that's a discount array should be considered as a reason to go higher. And you can see the price action here. It's just a straight run up. They're not letting this thing go down. They don't want it to go down. And they've already indicated down here that it shouldn't because it's kept at bay. It won't go to a discount. When this inefficiency right here, let me move this over so you can see a little bit easier. This candlestick's low, this candlestick's high. In between those 2 points, this candle's high, that candlestick's low. This portion of price action it should have carried the market down to at least half and then rally. That's a normal bullish market. That's normal. Can it come all the way down, fill that in, and go up? Yes, it can do that. But when it does that, I'm far less bullish on the marketplace. I would want something after it closes the fair value gap in. I would want something over here, create a new shift in market structure on a smaller time frame, and then look for this same event where it doesn't fill in a fair value gap. And then I would resume going in looking for longs. I don't like to trade a full closure of a fair value gap. I like to do that when I'm short. And if it trades down here, that's where I'm trying to take profits. But I do not like to buy a full closure of a fair value gap when it's a buy side and balance, sell side efficiency, and I'm bullish. I don't ever want to go in there and do that. Look at my trades. Do you ever see me executing like that? It's never happening, folks. It's never happening. You learn more from studying my executions than trying to come up with these, you know, hypothetical, he's doing this, he's doing that. Just look at what I'm doing. I mean, look at where I'm entering. I'm entering at the best places at the best time, and I'm looking at areas where they don't fully close in, or I'm entering just after that's occurred. That's like the biggest tip and hint I could give you as a smart money operator. Like I'm telling you, literally, that is worth its weight in gold. They all want to see these closures. That's not what I've never taught that. I don't want to take those trades. I don't mean that it can't happen. Yeah, that's sure it can happen, but I'm not going to enter on that basis alone. I want to see it. If it's going to do that, then I want to see it. Give me some more proof. Then it needs to climb to the upper half of that inefficiency. Then give me some kind of a smaller 1 minute, 5 minute time frame shift in market structure where it gives another fractal form of this bigger buy side and balance sell side efficiency, just done on a smaller time frame. And then if it can fail to fill in that one, then I'll start going in there and following order flow that way. But you just can't go in here and just simply say, well, there's an inefficiency and I'm going to get real, real bullish once it goes there and I'm going to buy that. Because think about it. If it's going to go higher and you want to be in markets that want to go higher, if you're bullish, and if you want to be in a bullish market, you want to be in a bullish market that's going to take off and just run and run and run. If you ain't seeing signatures like this in price action, you don't have an A plus situation where you're buying strength, really. You're just going in there buying something that is no different than support resistance. You don't know if this is going to come down to that low of that fair value gap and bounce. In fact, I'll go so far as to say this. When it does that, I'm admitting to you, when it closes the fair value gap in, I don't know. I don't know if it's going to stop there and go higher, which is exactly why I gave the rules that I give you. I wanna see it not fill it. But if I'm in a long and I have a stop loss that's maybe at consequent encroachment or tick below it, and it starts trading below the upper quadrant, I'll kill that trade. And then I'll wait for it to come down and do whatever business is gonna do. And I'll take that loss. It's literally just like paying an insurance premium. It's all it is you're paying an insurance premium. I'm ensuring that I'm not gonna sit in a larger loss, but I'm protecting myself and I'm guarding my mental capital. And then I'll wait for what I would rather see is that to show me a willingness to come out of that. If it goes in the lower half, it needs to come back out of that and then give me some supporting structure in a lower time frame where it does the same thing here, a buy sign, a balance, sell sign efficiency that does not fill in on a lower time frame. Then I'll hop back on and start building my position up with half the position I took as an initial loss in here, absorbing that because maybe I got a bad read on it. Maybe I was a little too overzealous or whatever. But I don't ever wanna be buying full closure of a fair value gap. I don't want that. I wanna see them stay open. So when we saw this, buy side, sell side inefficiency, BISI, fair value gap, this is the biggest opportunity to see how much strength does gold really have. And this is not limited to just gold. You wanna use this same concept anytime you're bullish. Anytime you are bullish on any market, if there's an inefficiency that's visual in the price action, you wanna see what's being shown here. But you, in your limited understanding, when you come to me, you'll see that as I missed a trade, it didn't give me what I wanted because I wanted to buy consequent encroachment or upper quadrant, and it starts to run away. Well, if it's showing it on a daily chart, all you have to do is drop down to an hourly chart, a 15-minute chart, or anything less than, and look for anything that's bullish at the right time of day. Macro times, you saw that probably in the notes, it's staring you in your face right here. We'll cover it in a minute. Those factors, when they come together, it's just like the puzzle pieces fall exactly how they should be. They dovetail nicely, and then you're on board. It doesn't mean you're gonna do it perfectly, you never have a losing trade. I'm just saying that this is what I do when I'm following a market that I'm primarily bullish on. But gold's doing nothing different. It still does the same things, but here's the caveat to this, okay? Gold is so manipulated. It's so suppressed. They do not let this market go to its real valuation. If it were, if it really was allowed to be at its real valuation, it would put Bitcoin on welfare because it's the world's currency. It's the world's money, gold. But anyway, when it's down here, what was the premium array that it would reach to if it's going to go higher? This high right here. Since this is the highest wick compared to that one, this premium array, when price is down here, if it's going to draw up to this high, before it takes that high, we want to know what levels this wick offers in terms of grading it. So we have the low, which is the close of that candle, the lower quadrant, consequent encroachment, midpoint, upper quadrant, and then the high of that wick. And these levels are being shown here. Now watch, I'm gonna give you a tip, okay? So these levels carrying over to the right, when price trades up to them, if, now watch, if when we trade up to premium rates, we went down here, that's this right here. All these moves from these lows here is this just shown on a 5-minute chart. That's this right here. So if it's gonna go higher, we've been bullish for a while, at least we would try to see it trade up into this high. That would be the draw on liquidity, the 4,081 level. If that's the case and it's a wick, we grade that. How can we know that a move like this is gonna come where it just keeps surging higher? How can we know that's gonna happen? Do you have anything that's gonna teach me how to expect that? How can we anticipate these really big extrapolations in price action? How can we do that, ICT? Well, what you wanna do is you wanna go and buy this retail book, okay? John Murphy's Technical Analysis of the Financial Markets, okay? And everything in that book, you wanna study it and then learn to fade it. You want to look at it and say, this is 90% likely it's going to fail. And then look for instances where they see price where it went up here like this and then turned and went lower. They're going to see that as resistance. What you want to do using my gradient levels, that's this area right in here. Okay, so now watch. I'm going to zoom in. If the market's bullish, this area here, the market moves off that inefficiency on the daily chart. Then it comes back down in the order block here and then rallies. It starts moving higher until we get up into that daily wick in this vicinity right here. That's this premium wick. So in this portion of price action on this day, which is yesterday's trading, if we look at that like this, you want to your eye needs to be inside this little area right here. As soon as we enter that, you want to study how is price reacting when it gets to every quadrant and consequent encroachment level. Here's the tip, okay? If it can trade through the quadrant levels and it doesn't stop, like see how this right here went right to it and stopped and went lower? If you see that at anything like the consequent encroachment or the lower quadrant, and there's no bodies in the upper half or above the consequent encroachment level, then this is probably going to have a turtle soup scenario. In other words, it's going to come back down and maybe come back into this inefficiency. Okay. Now here's the $1,000,000 concept. Okay. This what I'm gonna show you and tell you about right now is how ICT literally knows how to hold on to these big runners. This is it. You ready? Watch. The quadrant here, while we're bullish, the body was laid over top of it. And then we had this deep retracement. The only thing it went down to is this volume imbalance to that volume imbalance, which is what? I just taught it to you. Suspension block. It comes down to it here and then rallies up. The bodies stop below the upper quadrant, but reference that wick. It's above this candle's high and it pierced, it's colored above the upper quadrant. So anything like this is consolidation in here. For you retail ricks that like to trade bull flags and bear flags, this is when your bull flags will work because it's indicating the quadrants are being colored above. It's exploring above it. Discovery is permitted in price above the quadrants and they're not stopping price. They're coloring above them and then coming back in. They're going above them and then coming back in. But if you look real close, the quadrants are supporting it as a discount. Below, look at the open on that candle there. They wick just a little bit above it here. All of this consolidation around it. Look at the bodies coalescing around that. Consequent encroachment. We stop it here, trade back down in, and then boom, they let the cork out of the bottle. Bang, it's gone. And if it's doing that in a market that's really bullish after creating something like this, where we have a big buy side imbalance, sell side efficiency that doesn't even trade to its upper quadrant, man, you have a javelin. Like this thing is leaving. It's got someplace to go, and it ain't going to wait around for you. And that's when you see it release here. And this is one of those instances where it leaves the area of focus, which is this premium wick. But when it trades above it, this premium wick acts as what? Is now a discount array. So the bodies are laying right on top of the high of it, and then they just start just letting it go higher. In your charts that I shared this morning in Telegram, you see me do this. This is the ICT New York open kill zone, 7 o'clock to 10 o'clock in the morning for all markets. Swing low. Market drops down, clears the sell side, and then leaves. What's this up here? What's this high versus this one? High probability candidate for what? A run on liquidity. So if we have relative equal highs like this, and watch the bodies, did we really do the business of laying a body over top of that high? This was just a small little shallow run. That means anything that was up here slightly above this wick is unfinished business. Unfinished business is a run on liquidity that was not completed. It's just a partial, just a tiny little drop down and then leave. No. No. They want that money. They want those orders. They want that. So everyone that's short here that had a stop loss, and who would be wanting to short gold? Look at freaking social media. Look at them. But if you have a buy side liquidity pool that's framed properly, as I give you, this is the right high needs to be lower than the high to the left of it. But a low and a higher low to the right of it, that would be a candidate for what? It's a high probability candidate for sell side liquidity pool being purged. But if the market's bullish, you don't look at that like that. But if the market's bullish and it's left this, you want to see bodies plunge its way up into that But look what they've only did what? The wick. And then it drops down. The market did not leave a body out there. So it's dropping down. So you're going to see that as, oh, it's a short. And the only thing it's doing is dropping down into a discount array, order block, rallies up, clears it, and then leaves the body right there. That's officially running the liquidity here. If you know how to frame this setup, which is something I taught in high probability short-term trading and scalping, it's a couple videos. You don't even need to spend that much time doing anything with it. But then studying it, these setups appear every single day, every single trading day. And it occurs every single New York open kill zone. It may not be a long, it may be a short, but it's always there. You need to know where the draw on liquidity is. How can I do that? Give me a bias. Tell me how to do. You seem like you're very giving today. Well, if you're bullish because you have something like this, seeing a situation like this is a loaded deal, easy, like it's a no-brainer. But see, when you see this and it goes right here and that's the end of the trade, you look at all this and you're thinking, this is a stupid model. Look at all the money I left on the table, not realizing that you didn't hear what I said. This model here is an everyday model. You have to subscribe to whatever starting point you want to reach for that's realistic. If it's silver bullet, that model, which is very simple, it's time based, you're only looking at 1 hour of time. You're waiting for 10 o'clock in the morning Eastern time, and you're waiting for this type of scenario here. I gotta put it on a 1 minute chart. It's driving me nuts. The idea of simply waiting for one setup, one little framework of price action within a defined range of time. Very, very specific element of price action that is limited to just one specific thing. See how even the candlesticks on the 1 minute chart didn't lay over top the high? So this is that buy side and balance, sell side efficiency on the 1 minute chart. So unfinished business in your notes, anytime a liquidity pool, when it's bullish, if buy side's been taken but no body's been left above it, it's unfinished. Expect it to come back for it again. So anyway, if you are a gold trader, okay, and you don't put this information on your chart, you're trading blind, and it's information that you need to have. Okay, there's several opening prices that I think you should have. This is the part when you grab your pen and write down, put the Doritos down. Grab your pen and write this down. Every midnight opening price Eastern time, whatever asset you trade, you need to know that price. You need to know the 9:30 regular trading hours opening price when the opening bell for the stock market starts. That's this one here. So it's 9:30 in the morning Eastern time, and just label it whatever you want to label it, and then put your date on it. You're going to see a lot of things by having 20 days worth of regular trading hours opening prices on your charts. You're going to see shit you never seen before. You're going to say like, what in the world? That was there, all that? Yeah. Oh yeah. Midnight Eastern time, 9:30 in the morning, 6 o'clock reopen time, all assets. But yeah, but Forex doesn't, I didn't say anything about that. I said this is the time you have on your chart, 5 o'clock p.m. and 4:14 p.m. Eastern time. Okay. That's enough for right now. You don't need any more. That alone will start giving you x-ray view of price moves that you've never seen before. They're there. And the model I just outlined here, that little simple little crackerjack of a model where it's just simple, unfinished business, it repeats every single day off of one of those opening prices too. Oh no, he just did it again. He just gave away. Yeah, I did. But anyway, here's the equities opening price here, and it trades down to that, and you get that run here. But then we see it trade down into the macro of 2:50 p.m., 3:10 Eastern time. Now let's zoom in here because I really want you to see. This candlestick comes in at 3:08, so 8 minutes after 3 o'clock Eastern time. But this is gold, and it's the last trading hour of equities, right? For regular trading hours. Gold's going to behave just like this when it's animated. Now, normally, when there hasn't been so much fever around gold, you wouldn't see big runs like this, but you would get some kind of a little setup that can be traded on a 15-second, 30-second, 1 minute chart, 5 minute chart, that type of deal. But don't expect like big, big, huge payouts. But because it's so animated right now, because it's so like energetic, it's trying to get somewhere and it's moving a lot, you're going to get these really nice responses like that. Like, I mean, look at that. That's a beautiful response. What do you think that is right there? What is that? High probability candidate for a run on liquidity. Here's an inefficiency. We trade down into it. Couldn't get to consequent encroachment or halfway point. Well, you could see it without having any fib on it. Here's the halfway. Here's quadrant upper. Could it touch it? Nope. And it's rallying. This easy draw hits it. Keep your eye on this down here. Okay. There's that larger 5 minute. Same pattern. Flat top right here. Easy, easy sucker play. And it gets up to this level here and then comes all the way back down to some random 9:30 opening regular trading hours price. Again, look at that. And then what does it do there? It sweeps it. It clears up the liquidity below here and then rallies up. Old fair value gap. Picks it up here. What level? This is gold, guys. You said the shit doesn't work in gold, right? What's this price say right here? 4,116.5. Oh my goodness. What is the price low on that? To the tick. To the tick. NASDAQ. Bottom line is this. Daily chart last Friday, literally controlled demolition. Okay. I'm going to say something to you. Okay. And I want you to just think about it. What time of year is it right now? It's in the fall. In the fall, stocks generally make a low and then they go higher into some measure of usually the last week of January, maybe the first or second week of February. And then it creates some kind of short term, intermediate term high. And then starts either if it's a bearish at that point, then it starts working towards the April, May highs. And then this works its way down through the summer into the fall lows. But we're in a market that is being propped up. It's primarily bullish. There's no one can argue against that. But if it's in a primary bull market, it can't trade down to a fall low like we would expect in a normal, non-parabolic, bull market. So wouldn't it be suspicious to see how on one day they did a controlled demolition, just like 9/11, and then now we went up here yesterday, and now we're right here, and they used this old discount wick low, perfectly delivered there, okay, and look at this candlesticks right here, the September 25th. What's the low? You're going to look at this price right here on my current cursor right here. What's that candlestick low? 24,422.50. Okay. Over here this morning, this candlestick right here, it's low, 24,421 even. So it hits it, trades minimum one tick below it for spread aspect. But look at the reaction there off of that. This is the inefficiency that you see on the 5 minute chart. And it trades down into it here. When we have a wick like this candlestick here and this right there, whenever it's a old inefficiency, I look at this as immediate rebalance the same way. It's immediately rebalancing because it's going right back to the top of the inefficiency, which is this candlestick's opening price here. It need not trade down to that. It's doing the same function as a candlestick to candlestick touch. Like in other words, if this candlestick's high touch this candlestick's low, that's immediate rebalance. This is the same element of immediate rebalance because it's using the inefficiencies high as the immediate rebalance. It's going right down to it doing like that. And even though there's a small little gap, guess what that's telling you also? Would you want to see that close in if it's bullish? If you're bullish and you wanted to see it go higher, would you really want to see that if it touches the high of that inefficiency? Would you really want to see that completely close in? No, you wouldn't. Why? Because it's indicating that it doesn't even want to give that discount there either. And that's exactly what I call it a signature for. Smart money sees that and it's like a flag to them. It's like a big alert. What's this? Relative equal highs. Right high is lower than the left. This is a strong candidate for price wanting to run through. Same thing here. High, lower high. When the market starts to run, this is protraction, where it just starts to escape and run. And it runs above those relative equal highs here and it continues to go higher. But I want you to see how it uses this old discount wick. When price was up here, it opened and traded down through previous days low and into the new week opening gap, which is this candlestick's close and this candlestick's open. Go back to a 1 minute chart. The candlesticks bodies are respecting the high of that 5 minute inefficiency that you can't see on the 1 minute chart. See how it's all muddied up? It rallies up. And then now look what it's using here, 24,582.25, upper quadrant of this discount wick. Okay, so the 25th of September, we're trading up to and above that upper quadrant. Look real close, folks. Real close. We traded the low of that wick on the 25th of September, right there. Nails the low of the day. And then it rallies up. And it does something strange, unheard of. It climbs above the lower quadrant of that discount wick right there at 24,475 and three quarters. Take a deep breath. Ground yourself. Ready? This is how easy this stuff is. These quadrant levels, whether they're on an inefficiency, like a fair value gap, or an actual gap in price where there's no trading at all, or it's a wick, which we treat the same way. Both of those things, I guess technically would be three things, right? No price at all is a vacuum block, which is no, that's a real gap. There's an inefficiency, buy sign imbalance, sell sign efficiency, sell sign imbalance, buy sign efficiency, SIBI, BISI. Those are fair value gaps. They're inefficiencies. And then you have the candlestick wicks. We treat them the same way. We grade them. Listen to me, listen to me, listen to me. Here it is. You ready? Every high probability fair value gap, every fucking one of them lays on top of a quadrant that I've been teaching you since I started back here again. What do you see at 24,475 and three quarters? What do you see? We went down to the low of that wick, and then it starts to go higher and pulls back to this quadrant. In your mind, okay, how's ICT going to think about this? What's the internal dialogue of ICT? What's the inner musing of ICT? Hmm? Well, if we rode this down, well, well, shit, then I can use an imbalance on the pathway down. That means, well, this is one right here, but is it on top that quadrant level? Mm-mm. But look, look, what do you got here? Oh, look at that. We got this one right here. You see that? Well, where's the consequent encroachment of that fair value gap? At the fucking perfect level on that quadrant. Is that one thing telling you? Nope. Is it all by itself? No. It's telling you that right here is that sweet spot. And you can accumulate along right there. And you need not concern yourself with this bullish breaker. If it's bullish, would it want to wait around to come back for a bullish breaker? If this is a V bottom? Nope. Rips right through it and leaves this right there. This is what you want to see when it's bullish. And here's 930 right there. Okay. Keep going forward. What do you see right there? What is that? What is that? Holy smokes! That's that shit he said first present the fair value gap. Oh my goodness. I already pick it up in the force. The Jedi Knight knows exactly what's going on. You're all vibrating right now. First present the fair value gap. Just happens. It just fucking happens to lay right on top of the upper quadrant of that discount wick. ICT cherry picks the perfect fucking PD arrays all the time. You're going to tell me that that shit just so happens to match the fuck up with consequent encroachment. And if you don't see it that way, here's your fair value gap laying right on top of the halfway point or consequent encroachment of the first percent of fair value gap. The market goes up and trades right back down to that new week opening gap high and does what? It leaves. And then we get first percent of fair value gap. It becomes an inversion fair value gap because it's SIBI here. Now remember, I'm down here. I'm calling your attention to 24,660. And it's going to start and originate off of new week opening gap high. You don't need to be down here. You don't need to be here. You don't need to be here. You can be right there and do very, very well. If the technical science doesn't line up like this, my ass ain't taking a fucking trade. And you get that? There has to be something else behind the scenes.